Ever wondered how businesses keep their finances in check? Imagine a world where every financial move made by a company is meticulously recorded with the precision of a Swiss watch. That's the essence of double-entry bookkeeping, a method that ensures every penny is accounted for, keeping the financial universe in balance. Double-entry bookkeeping operates on a simple yet profound principle. For every financial transaction, two entries must be made. One account is debited and another is credited. This dual recording system maintains the fundamental accounting equation: assets equal liabilities plus equity. Consider the case when a company buys inventory worth $1,000 on credit. Here, the inventory, an asset, increases. This increase is recorded as a debit of $1,000 to the inventory account. At the same time, the company's obligation to pay for this inventory, or accounts payable, also increases. This increase in liability is captured as a credit of $1,000. Thus, the purchase is neatly recorded, ensuring the company's books remain balanced. Now, let's look at salary payments. When a company pays its employees $2,500 in salaries, it decreases its cash, an asset, by the same amount. This reduction in cash is recorded as a credit of $2,500. Concurrently, the expense of paying salaries, which affects the company's net income, is recorded as a debit of $2,500 to the salaries expense account. Again, every action has a reaction, keeping the financial statements in harmony. What about when goods are sold for cash? Suppose goods worth $3,000 are sold. The company's cash, an asset, increases by $3,000, recorded as a debit to the cash account. Simultaneously, this sale boosts the company's revenue, which is recorded as a credit of $3,000 to the sales revenue account. The symmetry of debits and credits continues to uphold the balance of the accounting equation. Lastly, consider the repayment of a loan. If a company repays $5,000, it reduces its liability under loan. Payable by $5,000, a debit entry. This transaction also reduces the cash, an asset, by $5,000, a corresponding credit entry. The financial echo of each debit has its credit counterpart, maintaining equilibrium. In summary, double-entry bookkeeping is not just about keeping records, it's about maintaining financial integrity. Each debit has a matching credit, ensuring that the total debits always equal the total credits. This meticulous method provides clarity, accuracy, and a comprehensive picture of a company's financial health. It's the backbone of financial reporting and a critical tool for anyone involved in the financial aspects of a business. By understanding and applying double-entry bookkeeping, businesses ensure that their books are always balanced, mirroring the true financial state of affairs.